Here to discuss the highs and the lows of the stock market, Tom Hutchinson, senior editor of the High Income Factor financial newsletter, who joins us quite fittingly, I won't say within spitting distance of Wall Street, but close by there from Newsmax, New York. What's happening this week? Why the instability, Tom?
Well, this is a little bit more of a return to normal. I mean, we've got used to the past couple of years when with the Fed backing everything up, it was a nice, smooth ride. Now that they've taken the money printing away, it's a little bit of a rougher ride. You know, the market's conflicted here. On the one hand, it wants to go up like it always has over the past couple of years because money has no place else to go, and the economy's also picking up. On the other hand, there's a lot of disturbing things going on that's making the market really quite uncertain. So you're getting a lot more volatility than we're used to.
The Swiss central banks shocked the financial world by abandoning its cap on the euro. Could you tell us what fallout could this have on the market?
Well, you know, I don't think it's that big of a surprise. The Swiss were likely going to have to do this after the European Central Bank chooses to ease later this month because there's simply too much pressure. So they got out in front of the curve a little bit, but this is what we're going to see with these stimulative policies of central banks in Japan and Europe. You're going to see more of a devaluation of those currencies. And you know, this is going to continue, I think, throughout much of the year.
What is your take on oil? Are those prices going to stabilize? Are we going to see them continue to drop? And we're loving the price of the pump, but there is an economic consequence to that cheaper oil, is there not?
Yes, there is. And this is a wild one, is it not? I mean, it's down, at least yesterday, it was down 57% from where it was just this past summer. And, you know, I think the problem is oil it can't seem to find a bottom. Now, you know, I'm sure you have a lot of other financial types and Wall Street people on the show. And they always seem to point to, oh, on the third Sunday after a midterm election, the market does this, and in January it does that, and an odd year it does that. They're always looking for these measurable things to base their trading on. But today's oil market doesn't have any of those because everything's brand new. Never before has the United States been a powerful oil producer. Never before has OPEC been this weak. It's a whole new dynamic, and there's nothing that traders or Wall Street can really sink their teeth in to say, gosh, this is a sign of a bottom. So nobody knows where it is, and it keeps falling, and it's anybody's guess where it's going to stop.
Tom, there's been a lot of talk about stagnant wages. What effect would you say this is having on our economy?
What effect are the falling oil prices going to have?
Stagnant wages.
In other words,
well, obviously, I'm sorry?
Go ahead, Tom.
Yeah, I mean, stagnant wages are a big structural problem in the economy. They've been sort of stuck in the mud for even before this recovery began. And that's one of the key things that is going to have to pick up. Now, if this recovery, and I consider ourselves in the sweet spot of the recovery, if it can still last for a while, I think you'll see wages start to push up. But no question, that's one of the main reasons why this particular recovery has been a far cry from what we saw in the 80s and the 90s.
So now this is interesting. You characterize this as the sweet spot of the recovery. Even with some of the structural
Correct.
problems, that's an optimism we don't often hear, Tom.
Well, let me clarify a little bit, if I may. You know, it's really looking at the economy is in two parts. There's the cyclical and the structural. The structural are those things you speak of: stagnant wages, spiraling national debt, increasing long-term unemployed, et cetera. And those are problems, and those are holding the economy back. But in terms of the cyclical aspect, we're at a high point in the economic cycle. This is the sweet spot of the recovery when everything seems to be kicking in. So basically, the economy looks good now because it's the best part of a lame recovery. But those structural issues will continue with us. Especially troubling will be when the economy starts to slow down.
So, Tom, let's look moving forward. What are your predictions about the coming year, good or bad, so to speak, for the market?
I think the market's going to generally stay good, with much more volatility. I think it's going to stay good because the upward bias, the same dynamic that the market has had for the past few years, is still here. I mean, where else are you going to put your money? What are you going to get, 1.5% in a bond? There's really no place else to go to earn a decent return. And that's not going to change this year, even if the Fed does raise interest rates in the middle of the year. But at the same time, we're going to get a lot more volatility along the road than we've gotten before.
A couple of minutes remain, Tom, and you mentioned the Fed. And we always end up talking about quantitative easing and just printing more money. Will there be a day of reckoning dealing with these low interest rates and really the value of the dollar?
Well, I mean, that's a very good question. I can argue that we're seeing some of that day of reckoning here because one of the less anticipated aspects of the Fed easing is we have exported our bad policy. In other words, the right way to do it is through fundamental reforms, not just through artificial stimulus.
And what we've been doing is that kind of artificial stimulus rather than those reforms. You know, the one problem, Tom, is the fact that no matter the value of our currency, we can't buy time. And it's gotten away from us. But Tom Hutchinson, senior editor of the High Income Factor financial newsletter, we appreciate your take on the economy. Thanks for joining us from Newsmax, New York. We look forward to having you back. Up next, James Herson, following this Newsmax Now update.